Here again with smart system. In our last lesson, we looked at the average true range and how many traders use this to get an idea of what the volatility of the market is, and then incorporate this one in setting their stocks. In today's lesson, we're going to look at another factor which many traders consider when setting their stops, supporting resistance. So let's get started. As we've learned in previous lessons, many traders will use technical analysis to determine where support and resistance is in the market, and then look for trading opportunities based on what that chart analysis tells them, in addition to using support and resistance levels to figure out where traders want to enter trades. Many successful traders also use support and resistance to determine where their stop should be placed as well. One of the most popular methods, which we've touched on in previous lessons, where many traders use support and resistance in their trading, is when trading ranges in the market. Many traders favor ranges as they provide them with the ability to enter trades with tight stop losses and much larger potential returns. The reasoning here is that traders can enter a trade just below the resistance or support level of the range, place their stop just outside that level, and then their profit target at the other end of the range. Generally, the distance between the stop level in this case is much shorter than the distance between the other end of the range, providing traders with a great opportunity for a relatively low risk and potentially high reward trade. Let's look at what I'm talking about here. We have a chart of the euro-dollar here, and we've got a market range which is drawn into the chart here, and you can see here that the range of that we've drawn here is 278 pips or points. If you don't know what a pip is, it's not important right now. So you can see a strategy based on entering a trade at the top or bottom of this range, and then placing a stop loss just outside that resistance or support level could yield a pretty low risk and potentially high water trade, even if a stop loss was placed 100 points outside the support or resistance line. The top of the bottom of the range here at 278 points gives you still a 2.78 to 1 profit ratio, which is pretty good. The disadvantage of this type of range trading strategy is that many traders will see the same range that you're seeing there and place their entry positions close to the range, and then also place their stop losses around the same level outside, just outside the support or resistance levels. So with this in mind, traders, when employing the strategy or faced with a dilemma of how far outside the range, place their stops so that they're protected if the market does move against them, but they don't get taken out on market spikes, which is, the market pushing up or down just very briefly through the support of resistance level to take out a lot of the traders' stops and then reverse and go in the direction that you wanted it to go the first place. So one method of potentially doing this is by incorporating the average true range, or ATR, which we learned about in last lesson. Here's the same market range, same chart we looked at in the last slide, and you can see here I've got an average true range plotted below, and when you run your mouse across that ATR, it'll give you the level. Most charting package will give you a level of the ATR. In this case, if we were entering the trade right here on the second bounce off of this support line that we've got drawn in, then the ATR at that point would have been 115 points. The strategy here would have been to enter long on the bounce there, and then put the stop 115 points, or 1 ATR below that long entry point. So hopefully at that level, we'd be far enough below that support line that if there was a spike down, we wouldn't be stopped out. And as you can see here, on the next bounce there or next touch of that bottom support line, there is a spike through the bottom support line on the next candle, which this time the ATR would have been 109, and we would have been outside of that range. So we wouldn't have been, in that case, stopped out on that spike through the bottom support line. So you can see here, same thing as with the last entry. That's the strategy would have been to enter long, and then 1 ATR below is 109 point stop below the entry price. Now, I use the example of one here. This is something that you're gonna have to play around with and tailor to your own strategy and time frame and chart that you're looking at. It doesn't have to be 180, or it could be 2 It could be 3 or it could be a percentage of 1. It could be 50% of 1 ATR. Half an ATR in terms of how far or how close you place your stop to that support or resistance line, but you get the general idea here. Now, just as an aside, we've got a little bit of a basic strategy here, so we can analyze that trade from a risk standpoint and see if it's something that would fit within the bounds which we've learned so far. So this is how you'd go about that. It's just a very basic example, but I thought it might be fun to go into right now. So here we have our range. If your member was 278 points, so that would have been our target for any trade that we placed on that range. And then we had a stop loss on our first trade. If you remember from the last slide of 115 points, so 278 115 gives us a potential profit of 2.41 times the potential loss. So this is a good thing from a profit ratio. Because we're over 2 here, we have a chance to earn a lot more on this trade. More than double than we're gonna lose. You know, not including slippage in commission, which we'll just leave out for some positives case right now. A 1-point move on the euro-dollar. Mini Forex contract is $1 per contract. So at 115 points, the stop loss in dollars per contract would be $115. Now, if you remember from our 2 lessons ago, we said 2% is a good level that many traders use as the maximum amount of their trading capital that they want to lose on any one trade. So here we have 115 10,000. If we're using a $10,000 trading capital as our example here, and that equals 1.15%. You know, with not including slippage in commission, just for this example as our loss limit there. So we're well within our 2% loss limit here, and it looks like we have a good profit ratio on this trade. Something we're gonna go into a little bit more detail of a later lessons. But you know, this looks like a decent trade, from a money management standpoint at least. So that's our lesson for today. In our next lesson, we're gonna look at how to set stops, using some of the different charting patterns that we've learned, and giving another factor there that you can consider when setting stops. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.